Well, we have flattening yield curves, low unemployment, small cap stocks doing well. Some would argue those are the warning signs of a recession on the horizon. I hate to throw cold water on today's action, but maybe not. We have strong consumer confidence, retail numbers. The American consumer is making a comeback. What does this all mean? Ernie, Cecilia, Chief Investment Officer, Bryn Mawr Trust, joins us now to make it. Look, Ernie, everyone can find something that they want to find in numbers. There are numbers, there are lies, damn lies, and then there are statistics. But for me, the overall economy is showing very broad-based and nice, strong, in every sector showing a lot of strength. And now with the consumer numbers, I can't see anything that's really going to knock it off, barring some big black swan event.
Well, actually, to your point, we would totally agree. The economy is doing very well. Obviously, a very strong second quarter, about 4% growth. It looks like the third quarter is going to come in at least with a 3+% growth. Consumer confidence is very strong, as you well point out.
Yeah.
And what's very interesting to us is that we've had a good period of time, really going back to the fourth quarter of 2016, where we've had corporate earnings growing at a very nice clip. So even in the most recently completed second quarter, and the earnings season is pretty well, reporting season is pretty well long in the tooth. We have earnings growing at almost 25% year over year, and the top line, or the sales line, if you will, growing at 10%. So we think valuations are very reasonable, but we also think valuations have to be carefully monitored, particularly in this, what we would consider the latter stages of an economic and market cycle.
Well, it's so headline-driven these days. How can the average investor handle all the ups and downs? I mean, where would you put your money? What are you telling your clients?
Well, our clients, we've told them to be very diversified across asset classes and within the asset classes, within sub-asset classes. We don't think this is a point in the cycle, actually, where you should be taking undue risk, for example, with respect to credit. We don't think it's a time to go out on the credit spectrum. So we're staying with high grades, if you will, investment-grade credit. We think there'll be a couple more interest rate hikes by the Fed on the equity side, being very diversified. You mentioned earlier, as you were leading into this, about small caps. Certainly across the market cap spectrum, the tax cut certainly has created more benefits down the market cap spectrum. You're seeing that played out so far in 2018. So we'd be diversified. And I think a real key, Ashley, and one that we stress and embedded into our process
5 seconds, Ernie,
is to look for high-quality companies with low debt. Thank you, Ashley.
Very good. Got it all in, Ernie. Thank you very much.